Today, Bitcoin reverses course, trading lower to end a volatile week. New research reveals hackers linked to North Korea stole $600 million in crypto in 2023. And economist Noelle Acheson explains the catalyst driving crypto's wild swings in price this week. Welcome to CNBC's Crypto World. I'm Tanea McKeel. Crypto prices in the red to close out the first week of 2024. As of noon Eastern, Bitcoin dropped more than 1.5% to just above $43,000, one day after the cryptocurrency crossed the $44,000 level as a spot Bitcoin ETF decision by the SEC is expected any day now. Ether dipped 2.5% and Solana fell back below the $100 mark. A little bit of volatility coming back into the market this week, again, as the anticipation of a spot Bitcoin ETF approval grows. We'll talk more shortly about what to expect with Noelle Acheson. For the week, Bitcoin rose more than 3%. However, Ether fell nearly 4% and Solana sank about 8%. XRP and Doge both dropped a whopping 10%. And then over on the equities side, crypto-focused stocks had a bad week, with Coinbase sinking 11.5%. Crypto miners Riot and CleanSpark fell too, with Riot dropping nearly 6.5% for the week and CleanSpark down more than 10.5%. Marathon and MicroStrategy, however, were slightly in the green for the week, all as of noon Eastern. Okay, let's talk about the top stories. Celsius is gearing up to unstake millions of dollars in Ether. On Thursday, the company announced on X that it will unstake existing ETH holdings to offset some restructuring costs. The company is in the process of reorganizing its business to exit bankruptcy brought on by the 2022 crypto meltdown. Celsius plans to focus on Bitcoin mining going forward, and in the meantime, it's been using staking rewards as a way to cover costs as it prepares to repay customers. According to Nonsense, Celsius has a total of about 206,000 ETH tokens awaiting withdrawal. That's worth nearly $459 million. Next, hackers tied to North Korea stole $600 million in crypto in 2023. That's according to research by TRM Labs out today, which noted that despite a 30% drop from the $850 million haul in 2022, the Democratic People's Republic of Korea, or DPRK, was responsible for nearly a third of all funds stolen in crypto hacks last year. TRM also said that nearly $3 billion worth of crypto has been lost to North Korea-linked hacks since 2017, noting that the DPRK's money laundering methods constantly evolve to evade international law enforcement agencies. The blockchain intelligence firm, which helps financial institutions, government agencies, and companies detect crypto-related financial crimes, warned that this year will likely see more disruption from North Korea, even with notable advancements in cybersecurity among exchanges. And finally, crypto companies have introduced risk assessments and finance tests in response to strict new rules on the advertising of digital asset products in the UK. Coinbase, Crypto.com, and other crypto exchanges are warning users in the region that they'll need to start filling out risk assessments and investment questionnaires aimed at testing their financial knowledge. The companies told users that starting Monday, they'll be required to complete a declaration about what type of investor they are and respond to a questionnaire covering a range of aspects of financial services and regulation to continue using their platforms. If they don't disclose the information, they won't be able to trade crypto. Since the passing of a major package of financial services reforms in the UK, firms that offer crypto must adhere to the same rules as those that govern traditional financial services. Coinbase spokesperson told CNBC that the changes were made to ensure the firm is meeting UK investor protection standards, which require users to have the necessary knowledge to make informed investment decisions. A Crypto.com spokesperson gave similar reasoning for the move, saying its changes were made primarily to ensure customers understand the risks of investing in crypto, which is a key component of the important consumer protections being put in place by the FCA. All right, back to crypto markets for our main story. Prices have been turbulent since the new year kicked off. I spoke with Noelle Acheson, author of the Crypto is Macro Now newsletter, to find out what's behind the big swings in prices this week. Of course, everything right now is about the ETF. No one has a crystal ball, but based on what is known, what do you expect to happen next week?
I expect we're going to get approval for the very first Bitcoin spot ETF. It really is quite epic. I mean, just a few months ago, most people that I knew were saying it's not going to happen, it's not going to happen. And now it looks like it actually will. Of course, it's not a done deal. We can't say 100% certain that we're going to get it next week, but it would be really, really aggressive move from the SEC were they to pull the rug now. I have been thinking a bit about what the worst case scenario would be. Obviously, the worst case scenario would be the SEC being totally aggressive and at the same time canceling the Bitcoin futures ETF so that we couldn't then say that it's inconsistent. They've never done that before, though. That is not even a 1% likelihood. If they really wanted to play dirty, they could delay again. That's possible. It would mean some scrambling on the part of the ARK ETF, for instance. Maybe they'd have to refile. Who knows? It's most likely that the SEC will give the green light next week, because not doing so is just going to create a colossal amount of work for the SEC, which, as they have often reminded us, is understaffed.
Yeah, I was just about to ask what the impetus would be to play dirty at this point.
It would be the SEC not having read through all of the documents, having perhaps some internal discussions they still want to have, or perhaps just being thoroughly pissed off with the entire industry. I'm not saying that the SEC is unprofessional, but that would be the impetus. So the most practical reason would be that they haven't had time to go through the documents. But again, I think that's very unlikely. The most practical thing to do now, the most efficient and the safest politically for the SEC, is just to approve these already.
There was a survey out by Bitwise. I don't remember if it was yesterday or the day before. I thought it was really interesting, a survey of advisors. And my takeaway from it was that many advisors are still thinking there is not going to be an approval, but that if there was, they would be very interested in helping their clients allocate through an ETF. What did you make of that survey?
We do have to bear in mind that most advisors don't follow crypto. Most, as we saw from the survey, in fact, which is an incredible document. I recommend everyone read it if they can. It shows that most advisors are not interested in crypto. Something like 70% have not allocated clients to crypto, and no, even more than that. Sorry, something like 90% have not, and 70% of those have no intention of doing so. So they're not following this, obviously. Otherwise, a much higher percentage than 40% would believe that we do have one coming. It is interesting that many of them say those that are planning to allocate are waiting for an ETF. Well, there's a solution to that. If I can throw in one more thing about that really interesting document you mentioned there, Tanaya, and that is, the most interesting part of that, always, every year, is the barriers to investment. That is the key of this document, for me anyway. And the big takeaway this time is that one of the key barriers, which is lack of a liquid, reliable, exchange-traded vehicle through which to get exposure, well, that barrier is probably about to be removed. And other barriers, such as lack of regulatory clarity, there's progress on that. It's slow and excruciating, but it is progressing. Others are the volatility. Fair enough. That's what investors' advisors have to take into account their clients' needs, and many of them can't really afford the kind of volatility. Fair enough. But one takeaway, my biggest takeaway from that list of the barriers, is that there is still so much education that is needed in this space. Many investment advisors say that they would not allocate crypto for their clients because it's a scam, or because they don't understand it, or because it's associated with illicit trade, that kind of thing. There's just a lot of education that is still needed. And here's the big kicker: the approval of Bitcoin spot ETFs is going to kick that education onto a different kind of level, different kind of mainstream acceptance. When we see Bitcoin in the same frame, in the same sentence, in the same ad as names such as BlackRock, Invesco, Fidelity, when Bitcoin becomes part of the mainstream financial landscape, that's a different level of education. And so we'll see that list probably change quite a lot between now and next year.
Let's get away from the ETF for a little bit. The ETF has been a big driver of Bitcoin price. What do you make of the volatility in crypto this week, which was not, Bitcoin alone? It seemed to be kind of a straight line up over the last couple of months. At least that's what it felt like. And then, a little bit more tumultuous to kick off the new year. What do you make of it?
Oh, it's welcome back, volatility. We'd missed it, to be honest. I mean, the doldrums of the past 2 years, I'll guess. I know 23 was a much better year than
I remember
22, but
before BlackRock filed their application, how absolutely flat and stagnant it was in the market last year.
absolutely. And even after the initial flurry of excitement had died down, volatility is not really back. It's a bit better, but it's not really back. Liquidity is not really back. Kaiko put out their Q4 report recently, which shows that liquidity in terms of market depth has not yet recovered to pre-FTX levels and hasn't really moved that much, even after the BlackRock announcement. Now, this could change once the ETFs are launched, because we do have some very big name authorized participants coming into the market, and it's going to be in their interest to do some market making on Bitcoin itself as well, I presume. So I do think this will change, and that is going to start a whole new flywheel of investor demand. The lack of volatility, contrary to what the Bitwise survey is saying, the lack of volatility for most institutional investors is a barrier. Bitcoin's volatility, to pick the largest currency as an example, it's a feature. It's not a bug. For volatility, there's risk. So the volatility is what compensates the risk in outsized returns. Also, volatility is what brings in liquidity, because for many of the market makers, if it's not volatile, they're not really going to be able to cover their hedging costs. So it's just not worth their while. High frequency traders as well, they need more volatility to be able to make money in the Bitcoin market. When they come back, volatility will come back, liquidity will come back, and the market will start to recover the luster that it used to have before everything went south in 2022.
Okay, that's all for Crypto World this week. We'll be back again on Monday, and we'll see you then.